Welcome to week 2 of managerial accounting. This week we're going to focus on two topics that are closely coupled, cost behavior and cost volume profit analysis. So you'll need to read both chapters 5 and 6, and I've also posted some supporting materials here which I hope will be helpful to you. These are some short videos and a reading that demonstrates how cost volume profit might be applied in a healthcare setting. So chapter 5 deals with cost behavior, which we're going to focus on two ways that cost could behave, either as a fixed cost, which means it remains constant, or as a variable cost, which means that it changes in direct relation to the activity level that occurs. And then we'll take that information and we'll create something called a contribution margin income statement. And then we'll do a cost volume profit analysis. So they're pretty straightforward. The math is quite straightforward, quite simple. And I think these are skills and understanding of cost that is important for people who would like to be in healthcare management or healthcare decision maker to understand. So as is the case every week, you'll have a graded assignment. I strongly suggest that you open the graded assignment up at the beginning of your week 2 studies so you get a sense as to the questions that you'll need to complete. You can open and close the graded assignment as many times as you like. It needs to be done by 11 o'clock on Sunday, May 28th. But if you look at the questions that are being asked, it'll help you focus your readings and your video viewing as you do the work. Also, I've asked you to participate in a discussion board question related to cost behavior and cost volume profit. And I'd like you to post something by Thursday at 11, and then respond to one or more of your colleagues by Sunday at 11. Okay, so throughout the semester, I'm always available. You can email me or call me. If you're in Boston, you want to stop by and talk things over, I'm happy to help you in any way I can throughout the semester. So let's talk about chapter 5 in cost behavior. So cost behavior is talked about in 3 dimensions in chapter 5, but we're going to skip over the mixed cost analysis, and we're going to just focus in on fixed and variable cost. So the first question you might ask is, why do I need to know about cost behavior? And essentially it boils down to, we want to know about cost behavior so we know how cost changes in relation to activity in the operation. And in our discussion, we're going to focus in on 2 cost behaviors, variable cost and fixed cost. And we're going to see that we're going to look at them on a per unit basis and in total. And we'll see how they behave or act at various levels of activity. So variable costs are those costs that change in direct relation to the volume of activity. So if you were to think about going into a store, let's say a store that just sells one product, to keep it simple. Let's say they sell water, and they buy the water from, let's say, Poland Springs, and they pay a certain fixed amount for each bottle of water. And let's say that bottle of water costs 50 cents for them to buy, and they sell it for $1. So every time that they sell a bottle of water, they have to pay 50 cents to Poland Springs. So if they sell 1 bottle of water, they spend 50 cents. If they sell 100 bottles of water, they spend $50 with Poland Springs. So what you should notice about variable costs is that it changes in total, it changes in direct relation to volume. The more I sell, the more variable cost I incur. The less I sell, the less variable cost I incur. The other nuance is that on a per unit basis, we consider variable cost as remaining constant. So, think about cost behavior and cost volume profit analysis as models. And models are always oversimplification of the real world, but they do have a purpose. And this is really a helpful tool to management. So when we think about variable costs, we most often think about direct materials. So in the case of the example I just mentioned, the direct material would be the cost that the retailer is paying to Poland Springs. Direct labor costs would be those costs that are directly related to building the product or delivering the service. In this case, we're going to just focus in on the direct materials. So total variable cost change would change in activity, but per unit variable cost remains the same with each change in activity. So the variable cost, as I mentioned, vary in direct proportion to change in activity level. So for example, if the activity level increases 10%, the total variable cost will increase by 10%. If it decreases by 25%, total variable cost will decrease by 25%. However, note that variable cost per unit remains the same at every level of activity. So here's some examples of variable cost: direct material, direct labor, sales commissions, gasoline on airline companies. So here's an example. The Damon manufactures radios and has a $10 digital clock inside. So the activity index is the number of radios produced. For each radio produced, the cost of the clocks increases by $10 per unit for the direct materials. So if 2,000 clocks are produced, we're going to spend $20,000 on that digital clock. If 10,000 radios are produced, then we're going to spend $100,000. And so this is how it looks graphically. See the total variable cost changes in direct relation to the number of units produced. So it's a linear relationship, but on a per unit basis, it remains constant at $10. Okay, so fixed costs are costs that remain the same in total, regardless of the level of change in activity level. That said, fixed cost per unit, because it remains constant in total, changes inversely with activity level. So the more units I produce, the lower my fixed cost per unit. And the less units I produce, the higher my fixed cost per unit. So examples of fixed costs, that is costs that don't change with activity, are things like salaries of managers and supervisors, property taxes, insurance, rent, and this thing called depreciation, which we're not going to cover in this class. But so in this particular case, it says Damon leases its productive facilities at a cost of $10,000 per month. So that's one of the fixed costs. So irrespective of the level of activity, fixed costs are going to remain at that $10,000. So if they produce 2,000 radios, it's still going to be 10,000. If they produce 10,000 radios, it's still 10,000. So what you can see here is that on a per unit basis, the more I can utilize my capacity, the lower my fixed cost per unit is going to be. So this shows it graphically. Here's the fixed cost remaining constant over the activity level, and here's my fixed cost per unit. So here's another example, and this is total fixed cost for Bikes Unlimited. This is from Chapter 5, Section 1. And what you can see here, in total, as I produce more units, my total variable cost goes up in a linear fashion. Okay, so we could determine the variable cost per unit by dividing the total fixed cost by the number of units. And that would remain constant over this activity level. So once again, what are fixed costs? That costs do not vary in total with changes in volume of activity. Examples: salary, personnel, rent, insurance. While fixed costs do not change in total, on a per unit basis, they're inversely related. So here's the total fixed cost for Bikes Unlimited. You can see it's going to remain constant over the level of activities. Okay, so Chapter 5 talks about mixed costs. We're not going to worry about it for our discussion purposes and for this course, but just as an FYI, all it is a combination of fixed and variable costs. So, for example, a lot of companies, they'll pay salespeople a base salary and then commission if they achieve a certain quota. We could view heat, light, and power in the same way. We always keep the heat and the light and the power on in the building, so irrespective of activity level, it's going to remain at a certain fixed level. But as we have more activity, then we have a variable component. But we're not going to worry about that for our course. The other thing we're not going to worry about in our course are the whole discussion in section 5.2 about how to forecast costs. Okay, so 5.2 talks about using account analysis, high-low method, scatter graph, and regression analysis, and basically that's to forecast cost. We're not going to worry about that or focus on that in this course. It's an interesting topic, but one that we don't have the time to or the need to explore in our 10-week journey. So I'm going to move on to section 5-3 now, which is going to help us understand the contribution margin approach to looking at our income statement. So section 5-3 deals with preparing a contribution margin income statement. So for those of you who took financial accounting or are familiar with financial statements, you may remember that income statements start with the top line of sales, which is the amount of money we take in for selling our product or service. The next line in a traditional financial statement would be the cost of those sales. And then we would have gross profit, then we have operating expenses, and then we have profit before tax. In the contribution margin income statement, what we're going to do is we're going to start with something called sales, okay, which is revenue of sales. Then we're going to deduct variable costs from that. And the difference between sales and variable costs is going to be called contribution margin. And it's called contribution margin because for every time we sell something, there's a certain amount that gets contributed to covering our fixed cost. And that's the difference between the sales dollar and the variable cost. So if I go back to my initial example of that person who opened up a store to sell water to people, let's say they sell their water for $1 per bottle, and they're paying Poland Springs 50 cents. Every time they sell a bottle of water, they bring in 50 cents to start to cover their fixed cost. And let's say their fixed cost are $2,000 a month, then they're going to have to sell so many bottles of water to cover those fixed costs, right? So if I'm making 50 cents per bottle contribution margin and my fixed cost is $2,000 per month, then that tells me I have to sell 4,000 bottles of water just to cover my fixed cost without making any profit. So that's where we're going to go with this. So we don't use the traditional method because that tells us something different. It's important, but not for this course. Okay, so what's the contribution margin income statement? It's sales, which is I sell things, it could be a product or service, minus my variable cost equals my contribution margin. Then contribution margin minus fixed cost equals operating profit. And this picture shows a clear activity. It shows us clearly how much profit or loss we have at each level of activity. So here's an example that is shown in section 5-3. So here's the traditional, which is sales, cost of goods sold, gross margin, and then operating expenses, and with a profit of 72,000. You'll see in the cost volume profit, we still have the 72,204, but we're going to break it up between variable and fixed cost. Okay, so that's going to be the key difference. So the contribution margin income statement takes sales minus variable cost equals contribution margin minus fixed cost equals operating profit. We arrive at the same endpoint, but our analysis has a difference in the middle. So here's another example. So we have this company, Vago. They sell DVD players, and their selling price is $500. Their unit variable cost is $300. So that's what it costs them to either make or buy that particular unit. Their monthly fixed cost is $200,000. So let's see what their profit is at 1,600 units. So if I take 1,600 times the selling price, that will tell me my sales. 1,600 times 500 is 800,000. My variable cost, remember, remained constant. $300 times the 1,600, that's $480,000. So if I take the difference between my sales and my variable costs in total, I come up with my contribution margin. and that goes towards covering my fixed cost, which is 200,000. So that is the contribution margin income statement. So it's called CVP, or cost volume profit income statement. So sales minus variable cost equals contribution margin minus fixed cost equals net income. So the math is quite simple, and there's nothing tricky about it, but what's important is what it's telling us. So I could put in any level of volume here. If I put in 1,000 units, we could come up with a number in terms of what would we make it 1,000 units, because my fixed cost would remain constant at 200,000. And then I could simply take 1,000 times 500, which is 500,000, and 1,000 times 300,000, I'm sorry, times 300, which is 300,000. And I would come up with a contribution margin, which in this case would happen to be 200,000, and minus my fixed cost would be my break-even point. So the other thing to keep in mind here is contribution margin per unit. So 500 selling price minus the 300 variable cost per unit is my contribution margin per unit. The difference is my contribution margin per unit.